Hey guys and girls, it's Nathan Birch here from Be Decentralized, and just wanted to talk to you guys today a little bit about what is happening out there in the bond market, in the bond yields, and where is the GFD going, how are we tracking for the credit crisis that we're going to see, and the collapse of all the currencies around the world. So as always, I'm not your financial advisor. This is not financial advice. Always try and just provide you with the information so you can have the knowledge in your hands to be able to make educated decisions where you can, in effect, be your own financial advisor and teach yourself to break free from the system that we're born into and enslaved into. So a lot of people, I've been talking about the bond markets since the start of 2018 with you guys, and talking about the possibility of the world's biggest collapse in the financial markets. And I believe that we are here in 2018. I did make a very distinct point of pointing out to us that we would see the markets globally start to fall off the tracks around March to May 2018. My words correctly or exactly or verbatim were what we'd see is that the lights would turn off, the music would stop, and people would realise that there's no chairs to sit on. And I think we're starting to see that throughout the remainder of 2018. And I said between August to November is when I feel that we will enter into the phase of no return. This can be for the exact day, that we'll see the stock market fall off a cliff, the Dow Jones fall off a cliff, and basically the world run to a scummage of, things to fix up and stuff like that. I can't give you that exact day, but what I can tell you is that we're right on track. The bond yield currently, I was predicting to see an inversion of the bond yield. For those of you that don't know what a yield curve is, or an inverted yield curve. An inverted yield curve is where the 3-month bond rate, US bond rate, goes higher than a 10-year. Basically, the 10-year US bond yield is basically the international standard for where banks adopt their rates to, and obviously, work on purchasing their money and whatnot into the financial system. Based on what we've seen over the course of the last 24 months, in September 2016, I think it was the 26th of September 2016, what happened is that the US Fed went from a quantitative easing perspective into a quantitative tightening perspective, which meant that they were printing a lot more money to obviously starve off the GFC back in 2008, 2009, and they stopped that program, and in turn they have stopped printing money, and they've started to take the money out of the system, and that's having dire effects on all financial markets around the world, whether it's property markets, whether it's financial markets, whether it's currencies dying, whether it's countries going bankrupt, and it's all corporations. And it's a very interesting time, exciting time for some, scary time for others. Those that are prepared and have the knowledge and equipped with the resources to do so, they'll be able to see this coming. And I guess it's my role to guide you through this, because it's something that I'm passionate about. Obviously, I've talked about property a lot publicly over the course of the last 15 years out there, 10 years very publicly. And a lot of people want to know the freedom side of life, the liberty side of life, and why I base my investing, and I'm passionate about being able to live life on my terms and whatnot. So, this all boils down. This is like another advanced level of what I've been talking about for a very long time now. But as we're in this phase, what are some of the things to watch out for, and what is happening right at this moment? So the ASX is down as of timing today. I think it's the 8th. Just checking on my phone. The 8th of October 2018. The ASX is down 1.5%. I predict that when the stock market opens this evening, which will be around 12:30 a.m. Aussie time, we will see some hits happening on the Dow Jones. I put a post up the other day, which I made back in July, saying basically the week of what we would see, and I believe that we're probably entering that week this week. and could quite possibly see some strong volatility out there. Basically, the bond markets are collapsing. That's why the prices are going up. And as these sort of trigger points go off, it will cause little explosions and things to go wrong. And it could, flow out in the financial markets, certain different financial markets. If I was to say that we're in, what sort of phase would we be in? And I had a big red button here and I was to hit it in case of an emergency, I would be hitting that now and saying that we are in the interesting phase of this cycle. The yield is up. Basically, if the 3-month bond yield gets very close to the 10-year bond yield, what will happen is that the liquidity would flow and people would put the money in the safer option, being only 3 months, for the same sort of returns. Basically, the 10-year Treasury bond yield has hit over 3.2%. I said that once it hits 320 basis points to 330 basis points, it will be very hard to control and will most likely hit up to around 350 basis points very quickly. And then from where up goes after that, it could be in free fall and go up to 4, 5, 6%, which will cause lots and lots of issues globally with liquidity for corporations, investors, bankers, and whatnot. This time frame could be in the next few days. It could be sometime this month, could be sometime next month. It could be delayed until next year sometime. But I have a very strong feeling that we'll still see it this year. And basically, a lot of people ask in as to what do I think will happen to the financial markets and where can you be safe? And there's sort of phases that will go, but you can't really, sort of predict exactly where to go until you see the movements of the central banks around the world and what their agenda is in order to, how would you call it, what they're actually going to do to stimulate the economy. So, but I believe that we're on the eve of what's about to occur, and there's no one else talking about this stuff out there. There might be, there's been doom and gloomers around there for a long time now, but I do feel that we're in a phase which will head off into the next phase of the GFC rearing its head back up. If you look at the 3-year bond, which I put some charts up on the Facebook page the other day, you'll see that there is the 3-month. There's like some spikes. It's done 3 times now, where it's gone up from 2.2 on the 3-month to 2.3, and then it's come straight back down. I've never seen that beforehand. It's very out of line, and it could be a sign of manipulation and suppression to try and hold down the bond yields so that it doesn't catch up to the 10-year. In essence, I personally feel that the US Treasury, the Fed, has already locked in and factored in another couple of rounds of rate rises, which will be included in this. Basically, as we see this pan out, there could be movements from other central banks around the world, be it the RBA here in Australia. If the RBA here in Australia feels a bit too much pressure, they may actually reduce their interest rates from historically low levels that have been here for the longest period of time, which is almost 24 months now. Could come down even lower, take off another 0.25%, another 0.5%, until we eventually hit zero. If that action occurs, what could happen in that front is that our dollar will fall further than what it already is and actually kill our currency a bit more. This will put pressures on prices such as anything bought overseas, anything imported, food, transport, petrol, so on and so forth. So I've got this theory. For example, people look at Bitcoin, cryptocurrencies, because we talk about that here quite often, that the crypto prices, let's assume that Bitcoin isn't, where it was back in January, but let's assume that in January it was $10,000 US, and it's still 10,000 now, just for an argument, just to see where I see some benefits of cryptocurrency. Once again, not financial advice and not your financial advisor, but if you had have had $10,000 in Bitcoin and had 1 Bitcoin in January, The Aussie dollar at the time was about $1.30 to the US, so your 10 grand Bitcoin would have been worth $13,000. Now let's assume that it still is $10,000 US for a Bitcoin, and we're looking at an Aussie dollar that's been depleted a fair bit from there, and you're looking at the conversion, you're probably looking at $1.45, so you're looking at a $14,500 Bitcoin. So in essence, if the Bitcoin price was to remain stable, which if we have a credit or a liquidity crisis, no one knows what could happen with that. However, if the dollar was to die further and was to end up at $2, then the $2 per dollar, we could see the Bitcoin that's worth 10 grand US would be worth 20 grand Aussie. So you're actually hedging a little bit with your cryptocurrencies that you're holding as well. I think that the interest rates will end up at a point of being zero, and basically maybe even into negative territory, which we actually saw all of the interest rates around the world at the central banking level enter into those points over the course of the last decade. I think that the bond markets, as they implode and the bond rate goes up a lot higher, we will start to see a lot of volatility in the stock markets, and could actually suck out a lot of that growth there, which could trigger a thing called a mark-to-market. Mark-to-market is like a margin call, and then it could be a run of things, which would head over to the derivatives market. The derivatives market pops, and basically what happens after that point is, you know, all hell breaks loose. Is it really scary? I think it's exciting. I think people will get hurt. I think that opportunities will lay out there. I've never been through a hyperinflation personally, as probably most of you haven't, unless you're from a specific country that's been torn apart. And maybe if you have been in one of those scenarios where you have experienced a hyperinflation in your life beforehand, maybe we could do a webinar or something like that to talk about some questions, and I could interview you on here. Or if you know someone, send them over my way and we could talk about what they saw through that time. None of us were alive during the Depression of 1929, so it's a bit hard to give exact advice. But what is very important is to understand that the news that comes out tomorrow or the day after is news from about 6 months ago. And it's important to have the knowledge so you know tomorrow's news today, because that's what's important. I've put a couple of little notes here. The other thing is to remember is that higher interest rates actually causes a squeeze on higher rates causes great squeeze on consumer confidence, business spending, and all those sorts of things, which is obviously what's causing us in a deflationary territory at the moment. But as an outcome from what would be the ramifications and what would be our path to safety here is being able to, I guess, in instance where this does occur, I could be wrong. I believe I'm right with my theory, but if I'm wrong, you know, business as usual. But if this does occur, the stimulus packages that would come out from around the world could be universal basic income, could be some sort of social spending projects, could be infrastructure projects, could be lowering the interest rates to a negative territory, could be you know, giving incentives. For example, we saw the first homeowner grant was $7 grand beforehand, which has been removed over the last few years. That could come back. It did go to 14,000 last time when we saw the GFC. There's deals that are done in the back end, like people being able to buy from China and Australia and stuff like that. That was a global phenomenon. But there's lots of ways that stimulus will occur, and it's until we start seeing those stimulus packages come in, do calculations as to, sorry, I still got a bit of a cough from my flu the other week, but as we see those stimulus packages come in to the markets and actually calculate how much money is being flown into the markets, printed, and how much impact that it will have, it's a bit too early at this point to you know, sort of suggest of where I'll be running to hide. But at this point, being very diverse, being very liquid, and taking advantage of opportunities as I'm seeing them out there in the marketplace. So yeah, just keep an eye out. The bond yields and the bond markets are very, very important at this point in time to see, what happens in them, because there will be signals that are in there which will flow onto other markets. So if you were to ask my opinion of what I see happening there, and it's a non-financial advice opinion, I personally think we're going to start seeing them jump up at higher levels and higher, how would you call it, faster. The momentum would be quicker, and as well as the fact that the yield curve may quite easily invert, which would mean that it would be a flat yield curve on that front. But as I said, just wanted to jump up today on Facebook. I do have lots of other things to talk about. However, I do want to keep this specific to the bond yield market. If you have put questions in the comment section, I will reply to them separately, and I will be hopping on the next couple of days with some more Facebook Lives with some other cool stuff. So we'll catch up soon. Thanks for watching. Thanks for having me as part of your evening. We'll catch up soon. Bye for now.